Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Joby Aviation.
And if you find our talks useful, please consider, subscribing, liking, and commenting underneath. It really helps us out.
It does.
Okay, so it's Thursday, January 29th, 2026. And we are looking at a company that feels like it's straight out of science fiction.
It's the one everyone is talking about this morning. I mean, if you were watching the tickers after hours yesterday, you probably spilled your coffee.
Spilled is putting it lightly. We saw some serious volatility.
Yeah.
It fell off a cliff.
I think it did.
And the weird thing is Joby posted what looked like absolutely insane growth numbers, yet the stock took that nosedive. We need to figure out what's going on.
It's the classic investor dilemma, right? Is this a complete disaster or is it a discount?
Exactly. So let's start with the basics, the business engine. What did that Q3 2025 report actually say?
Okay, so the headline number, the revenue, was $22.57 million.
$22 million. Now, in the grand scheme of things, that's not a huge number, but for a pre-commercial company like Joby.
For Joby, it is a seismic shift.
No.
You have to look at the year-over-year number to really get it. It's a 7,962% increase.
7,000. Wait, seriously, that sounds like a typo. Nearly 8,000%?
I know. It's absurd. And to give you some context, Wall Street analysts, they were expecting revenue of just 0.02 million.
So basically nothing.
Pocket change. They expected nothing, and Joby delivered over $22 million. They didn't just beat the estimate, they lapped it multiple times.
But I need to ask, because I think a lot of people get this wrong. I can't book a Joby flight to the airport yet, right? So where did this money come from?
That's the crucial point. This is not ticket revenue. This is from development milestones, mostly from government contracts with the Department of Defense. When they prove the tech can do X, Y, or Z, they get paid.
So it proves the technology is real enough for the military, but not that the commercial business model works yet.
Correct. Yeah. It validates the engineering, not necessarily the unit economics of a rideshare service.
Okay, so the top line is exploding, but
Yeah.
let's talk about the bottom line. Because with these high-growth companies, it's usually pretty ugly.
Ugly is a fair word. While revenue was amazing, profitability is still, a distant dream. They posted an EPS of negative 48 cents for the quarter.
Oof. And the consensus was what, negative 19 cents?
Yep. So while they crushed revenue, they actually missed on earnings pretty badly. They spent a lot more than anyone expected.
How much more?
Well, if you zoom out, over the prior 3 quarters, they racked up net losses of $888 million.
Nearly $1 billion gone in 9 months. That is a staggering burn rate.
It sounds terrifying, I know. But you have to remember, they're not building an app. They're building factories, certifying aircraft. This is an incredibly capital-intensive game.
So the losses are the cost of admission.
Exactly.
Yeah.
But that brings us to the most important question. How much fuel is left in the tank?
Right. So where do they stand?
As of September 30th, they were sitting on about $978 million in cash. So almost $1 billion.
That's a decent runway. But clearly management thought they needed more. Because the big news yesterday, the thing that really tanked the stock, was about them getting more cash.
Right. They announced a massive one.
Yep.
Billion-dollar raise through what are called convertible senior notes.
Okay, let's bring that down because I think a lot of retail investors hear that phrase and they just hit the sell button.
They do. But think of it as a hybrid. It starts as a loan. Joby gets the cash, and they pay an incredibly low interest rate, just 0.75%.
That's practically free money.
It is. But here's the catch. The lender gets a perk. Later on, if the stock price goes up, they can swap that debt for shares of stock.
And that's the dilution people are afraid of.
That's the fear. More shares means your piece of the pie gets a little bit smaller.
But isn't it better to have a smaller piece of a company that has $2 billion in the bank and can survive versus a big piece of a company that goes bankrupt?
That's the rational long-term take. This move funds them all the way through 2026. It basically removes the bankruptcy risk from the table.
So fundamentally, the company is actually safer today than it was yesterday.
Fundamentally, yes.
Yeah.
Even if the stock price is hurting right now.
Okay, so let's pivot to their strategy. Why Joby? There's Archer, Lilium. It's a crowded space. What's their moat?
It's what we call dual vertical integration.
Which is a fancy way of saying?
They do everything themselves. Most companies pick a lane, Boeing builds the planes, Delta flies them. Joby wants to be Boeing and Delta.
That sounds incredibly difficult.
and expensive.
It's ambitious, but if they pull it off, the margins could be incredible. So first, manufacturing. They control their own production, and they have a massive partnership with Toyota.
Toyota, the gold standard for mass production.
Exactly. And Toyota isn't just a silent partner. They are helping them design their huge new factory in Dayton, Ohio. That's a massive advantage.
Okay, so they build the plane, the S4. What's special about it? 200 miles per hour, zero emissions. But the killer feature is the noise. It is designed to be incredibly quiet.
Which is key for flying in cities. No one wants a helicopter roaring over their apartment.
Precisely. But then there's the second part of that integration. Operations. They aren't selling the planes. They're going to run the rideshare service themselves, the app, the vertiports, everything.
So they're the manufacturer, A&D, the Uber.
They want to capture that whole value chain. And this isn't just on paper. By December of last year, they'd already logged over 850 flights. 65,000 miles.
65,000 miles. That's a lot of real-world data for the FAA.
It is. They are walking the walk.
All right, let's look at the charts, because if you looked at the screen yesterday, you saw red.
Deep, deep red.
Shares plunged almost 11% after hours, down to around $11.85.
And it's not just the dilution fear. There's a mechanical reason this happens. Hedge funds buy these convertible notes, and to protect themselves, they immediately short the stock.
So they bet against the stock while they're lending it money.
It's an arbitrage play.
Yeah.
It creates huge instant selling pressure that isn't really about people hating the company.
Okay, that makes sense. But let's zoom out. 2025 was actually a fantastic year for the stock, wasn't it?
A banner year. It surged 62%. So even with this drop, we're still trading about 26% off the 52-week high, which was up year $21.
So we're not at all-time lows, but we did just crash through some important levels, didn't we?
We sliced right through them. We're below the 50-day moving average at 1444 and the 200-day at 1542.
And losing the 200-day is a big technical warning sign. The chart looks ugly.
It is a warning sign. But now we look for where the bleeding stops. I think we're seeing a psychological support base trying to form around this $12 to $13 mark.
And what about volume? I noticed that before the drop, the volume was pretty low.
Yeah, about 48% below average. That tells me this wasn't panic selling building up. It suggests investors were in a wait-and-see mode, and then the news hit.
A repricing event, not a fundamental fire sale.
That's the technical read, yeah.
Okay, let's move to the vibe check. Sentiment. What's the mood on the street?
It's completely conflicted. The short-term sentiment is, of course, net bearish because of this offering.
Right.
But the long-term bullish feeling from that 2025 surge is still there. And the big banks, they're in a full-blown civil war over this stock.
Okay, who's in the bull camp?
You've got Morgan Stanley. They raised their target to $15 back in October.
And the bears.
The bears are out in force. Goldman Sachs has a $10 sell rating. And JP Morgan is just, they're the grim reaper here. They're underweight with an $8 price target.
$8? Wow, that implies another 30% drop from here.
They're clearly focused on the cash burn and the regulatory risk. Morgan Stanley is focused on the technological reward. It's a total clash of perspectives.
What about the big money? What are the institutions doing?
It's a mixed bag. You had some funds like Y-Intercept Hong Kong sell almost their entire stake. The CEO, Joby has also sold some shares.
Which is never a great look.
No. But on the other side, who do you think is buying?
Let me guess. Kathy Wood.
Of course. ARK Invest has been buying as JP Morgan has been shorting. It's what we call cluster accumulation. The innovation funds are scooping up what the traditional banks are selling.
It's a battle of philosophies. So if you're a listener thinking this dip might be an opportunity, what should you be watching for over the next few months?
The first date to circle on your calendar is February 25th. That's the next earnings date.
And what are we looking for there?
It's all about cash burn. Investors need to hear management lay out a clear plan for how this new $2 billion gets them to profitability. They want to see discipline.
Okay,
Yeah.
And beyond that, the actual flying.
2026 is the year of FAA certification. That's the holy grail. We need to see them hit those type certification milestones. Without that, they have no business.
The permission slip to make money.
Exactly. And we should also look for public demos. They're planning them for New York City and LA. Seeing a quiet aircraft fly over Manhattan will make this very real for people.
I also heard some rumors about Dubai.
Yes. Speculation about a commercial launch in Dubai in late 2026. They're very aggressive with tech adoption, so it's possible they fly commercially there before the U.S.
That would be a huge catalyst.
Okay, but we have to talk about the bear case. What could kill this company?
Risk number one is still dilution and cash burn. That $2 billion pile of cash sounds huge, but aviation is a furnace. If FAA certification gets delayed by a year,
That furnace just keeps burning,
and that $2 billion evaporates. Delay is death in this business.
and competition.
That's risk number two. If a rival like Archer gets certified first, they grab the headlines and the first routes.
But Joby has those partnerships with Toyota and Uber to help mitigate that.
Right, and that's their shield. Toyota helps them build at scale, and Uber gives them a massive customer base on day one.
Okay, we've covered a lot. It's time for the verdict. What's
Yeah.
your final take on Joby Aviation today?
I'm giving this a bullish score of 7 out of 10.
A 7. So, cautiously optimistic, even with the big drop. Why a 7? Because the strong moat and the upcoming catalysts, I think, offset this near-term panic about the offering. The market hates the dilution today, but it's ignoring the fact that this money ensures the company's survival.
So you're saying the offering is actually a good thing, fundamentally.
It removes the existential risk. That's worth the price of admission.
So what's the elevator pitch?
It's the Uber of the sky, but with Toyota building the cars.
Yeah.
Revenue growth is exploding, manufacturing is scaling up, and if this works, you could be looking at a 5 times upside by 2030.
A 5x return. That's what makes the volatility worth it for some people.
But you have to have the stomach for it. I see this as a multi-year hold into that 2026 certification. This drop below the moving averages is an entry point for those willing to accept that risk. You are buying the fear.
Buying the fear. It's a high-risk, high-reward play.
Absolutely. This isn't a savings bond. If the market sneezes, this stock catches a cold.
So what does this all mean for you listening? It means we are on the cusp of what could be a transportation revolution, but getting there.
Getting there is going to be bumpy, messy, and volatile.
But for Joby, with a fresh $1 billion in the bank, at least they have the ticket to ride.
They have the fuel. Now they just have to stick the landing.
A fascinating story. Thanks for breaking it all down.
Anytime.
And thank you for listening. We'll catch you in the next one.